Welcome back. This is Catherine Morgan-Nance with the final video in our profit planning series. In part 6, we will briefly consider how all the budgets and schedules prepared previously come together in one set of budgeted financial statements. The budgeted income statement is a schedule showing budgeted income statement account balances and calculating budgeted net income or loss. It's used as a controlling benchmark for measuring actual performance for the period being budgeted. The budgeted balance sheet is a schedule showing budgeted balance sheet account balances. It's the most complex budget to prepare because information must be pulled from a variety of budget schedules and other sources, including beginning balance sheet data. Let's look at a quick example of each. The numbers for the budgeted income statement come from the other budgets that have already been prepared by Royal Company. When completed, it looks just like you might expect an income statement to appear. Sales revenue comes from the sales budget. The cost of goods sold on a per unit basis comes from the ending finished goods inventory budget, which we did not discuss in detail. The selling and administrative expenses come from the S&A budget. And finally, interest expense comes from the cash budget. In our example, Royal calculates budgeted net income for the quarter of $239,000. Now that we know net income, we can move on to the budgeted balance sheet. Because balance sheet accounts are permanent, they are never zeroed out with closing entries like the temporary income statement accounts are. Royal must consider the balances in certain accounts as of the beginning of the budget period, March 31st. Please make a note of the supplemental information as we'll need it to complete the budgeted balance sheet. And here is the balance sheet. Royal's cash balance of $43,000 comes directly from the cash budget. Using the cash collection assumptions, accounts receivable of $75,000 is 25% of June's sales of $300,000. Raw materials inventory of $4,600 is calculated by multiplying the ending inventory of raw materials in pounds, that's 11,500 pounds, by the cost per pound. The finished goods inventory, 24,950, is taken from the ending finished goods inventory budget, and the land and equipment amounts are equal to beginning balances plus acquisitions during the year. Accounts payable of $28,400 is based on our cash disbursement assumptions. It's 50% of June's direct material purchases of $56,800. And finally, the balance in the common stock account is given and did not change during the year. The balance in retained earnings at June 30th is $36,150, which is calculated as the beginning balance plus net income minus dividends paid. That's $146,150 plus $239 minus $49,000. And we're all done. Fantastic job. Thanks for sticking with it. The end result of all of this work is a well thought out financial plan that can be used to communicate expectations to management, auditors, and bankers. The budget will also be used throughout the year to measure and evaluate actual performance. More about that topic when we discuss flexible budgets in a future presentation. And that's it for our final video in this series about the master budget. Thanks for watching.